Wakaba, you can hear me?
Yup.
Okay. Okay.
Nilikuwa nauliza si umeruhusu nianze presentation saa hizi
Oh, you need to. Okay.
because my machine, my friend,
It might go off.
not going off. I wouldn't
Oh.
want it to hang just before.
Oh, okay. So stop sharing. Hi, Arnold.
Hi. Unasikia niko na assistant.
Oh, assistant ako. Hi, assistant. Unajua hezi ongea.
Unasikia assistant ako hapa na mimi.
Mama, huyu atakuwa finance expert. Tushamchukua wa finance.
Huyu ni finance expert huyu, lakini wanasema anafaa kuwa lawyer.
Oh, wamesema atakuwa lawyer. Atakuwa tax lawyer.
Tax lawyer.
Hata engineer. Oh my God. Hi, Ndeto.
Hi, Jasong. How are you?
Hey. Hi. Where is that English from? Ndeto, you're lost. Anyway. Wakaba, I can start you off because you've said you would like to start immediately.
Hey bana, kitu yangu najua sasa inasumbua.
We start?
Just hold on. Wait until I share.
Okay. Oh, okay.
That is what I've been trying, man. Super hectic. I think I should also share this presentation with you because I can't imagine going south there.
You can share. You can even WhatsApp it.
Actually, you can present from your side, is it?
Yeah.
Yeah.
I can.
I mean that.
You've sent it, Bado?
1 second. Mashine yangu naona inaweza simamisha kazi hapo. Yeah, so I've shared.
I have it. Let me present.
Sasa, for the issue of the Nini, because I felt this topic would be so wide, what we are going to do is we are going to, for the budget presentation, I think we are going to cover it in sort of an overview, a very sort of executive kind of a summary thing.
Okay.
And then for the finance bill, because it's also super wide, I felt largely biased towards maybe touching on issues that are issues with relevance to individual taxes.
Okay.
Which is also because it's what the bill majored on. Issues to do with corporate taxes ni kidogo here and there.
Okay. I think that's fine. Let me share the screen first, then share. I'm gonna share window. Let me share the specific window. At least you can see it. You can see it at least. Wakaba, confirm you can see it.
Oh, sorry, yes.
Okay. So Maybe I can start. I can do a small intro, then invite you.
Okay, that's fine. But also put whatever in full view or something, full screen.
Okay, I'll do that.
There's some button. Okay, fine. Someone.
I'm switching between screens. Yeah.
Okay.
Thank you everyone for joining. On today's session, we are going to have CPA Dennis Wakaba take us through the budget 2026 and the finance bill. He's an experienced tax and finance profession, having worked both in the service industry and manufacturing industry. He's previously worked at Kappa and presently does full-time tax advisory with Sagamore Tax, that's based in Westlands. He does hold a Master's of Science in Finance from the University of Nairobi and is also a certified public accountant Kenya. He has published numerous publications and articles, both in the field of finance and tax. He is also a board treasurer, where he oversees the financial health of the institution and has appeared on multiple media, both on radio and TV numerous times, to just give commentary on various government policy directions, touching on different areas, including finance, tax, and governance. He spends his free time reading and has interest in history and biographies on politics and business. He actually loves a double cappuccino. Welcome, Dennis Wakaba. The floor is yours.
Okay. Thank you so much, Mikaeli, and to everyone who are joining us this evening. Thank you so much for sparing your time. In this presentation, we are going to have a look at two things. The first thing is the sort of an executive kind of a summary for the budget, and also delve much more into the finance bill, where we are going to focus on a handful of things, especially because it's a very detailed bill and we might not talk about everything really in the next 1 hour. And therefore, without much ado, we are going to have a look at the structure in which the government really is going to finance its projected expenditure. And I'm hearing a lot of people talk about, that we are borrowing too much. We are, we are living beyond our means. And what that might be the case, really, we are also going to have the correct perspective, because it's not the first time that this is happening. It's not the first time really that we are borrowing, but also maybe to mention that there has been some differences in the structure of the borrowing, that the country really, the direction that the country is taking as regards how to structure its borrowing. And, just an overview of where we've come from and where we are, and possibly also where we are going to go to. You can see from this slide, you can see the budget, which for the financial year 2024, 2023-24, it was at 3.67, moved on to 3.99. Then we clocked in the 4 trillion Kenya shilling budget, and now presently we are at 4.8. And this is now being projected to hit 4.9 to between 4.9 and 5.2 trillion in the coming financial year. And therefore, I feel this is quite an increase, especially maybe just to mention before FY 2023-24, the budget was about 3.2 trillion. Yeah, and therefore, if you may take the last 5 years, that is an almost 60% increase in our budget, the structure of our budget in the last 5 years, whereby we are saying, we have an increase of 65% in as regards now the government expenditure. And maybe just to answer the question on how then the government intends to finance, I think we can see really the borrowing is going to be for the financial year 2026-2027. The borrowing is going to be at 1.1 trillion. But also that is what we have as of now. Yeah, all these things are going to be assented to by the president, but also maybe the most important thing that would be of importance to mention at this stage is because in as much as maybe the budget is going to be approved at 4.82 trillion, this is what certainly this is not what we are going to end up with, especially because we've seen the history of the country. Whenever we get to the month of March, April, thereabout, every other time we see the government then coming up with a supplementary budget, whereby, if, like, for instance, this past year, we had budgeted, the FY 2025-26, we had budgeted for 4.24. This is not what going to be the actual publication after the turn of the year at the end of this month, whereby, of course, there has been a supplement budget passed around February, March, thereabout, and this is projected to go all the way to about 4.7, 4.8 for FY 25-26. And of course, again, given the historical conduct of the government, then the actual budget for FY 2026, 2027 is going to go past the 5 trillion mark. And also maybe to mention that the growth in our borrowing is not corresponding with the growth of our collection in ordinary revenue. And with ordinary revenue, I mean the taxes. Yeah, that is the main way in which the government funds the budget, whereby while our budget has been growing with about, our budget has been growing, rather, our borrowing has been growing with about 10 to 15% year on. Our ordinary revenue are only growing with 5%. Yeah, so taxes are growing at 5%, but our borrowing really is between 10 to 15%. And that is a very big concern, really, because it can only mean that while there has been quite a number of government policies, in particular two government policy documents, that is the MTRS, we abbreviate it as MTRS, and in full it means the medium-term revenue strategy paper that was passed through the parliament in the year 2023 and is coming to an end in this coming financial year. It had projected to raise the ordinary revenue from about 14% to above 20%. Yeah, and most of the African countries, if you compare taxes as a fraction of GDP of a country, most of them are actually between 19 to 25%. Yeah, with majority of them being around 23%. Save maybe for East Africa and countries which are predominantly very not advanced as regards technology, of course, which has enhanced the tax collection by the government. Most of these countries are about 20%. That is tax compared to the GDP, and therefore, really, we still have room of improvement. But of course, this room of improvement really is not does not mean that we should make more laws. We should make more tax laws. We should make a lot of tax changes in the various taxing acts. But rather, the emphasis should be on the administration of the existing laws, because I can tell you for sure we have one of the most robust tax laws in Africa, in East Africa, and also in Africa. Maybe South Africa could be a little bit more advanced in terms of integration with the internationally accepted tax principles and tax practices, but we are not too far. We would maybe rank behind South Africa, and also maybe Egypt also. But the administration of the existing tax laws is what really needs to be emphasized. Yeah. So one of the provision of that particular policy paper, which is the MTRS that I was alluding to, had actually mentioned this very particular issue, and that is what the present finance bill is drawing largely on. Much of the recommendations that the finance bill then is seeking to make to the existing tax law is one of the taxation law called the Tax Procedures Act, and quite a lot of changes are revolving in that act. And this act is what helps in the administration of the different tax acts. Yeah. So I think it's important that we have that perspective, and also maybe to mention at this point, I had talked that, or rather I had said that there are two policy papers that the government really has been, giving a lot of emphasis on. So we've talked about the MTRS, and the second policy paper is the debt management strategy paper. There's a policy document that really outlines how the government then is going to deal with the issue of the ballooning debt in the country up to the year 2032, thereabout. And I think the CS has also been talking about how the issue of debt is not going to be it's not going to get any easier until to around the year 2032, which is what now then aligns with the provision of that policy paper. So if we would move to the second slide, which now really shows how the budget is going to be funded. We've talked about the 2.9, which is the projection in the collection of taxes. It's at 2.9 in the coming financial year. And then the borrowing is at 1.1 trillion. Of importance to note at this point in time is that of the 1.1 trillion in borrowing, 10% will actually be borrowed. It's only a 10% that is going to be borrowed externally. And the remainder, which is about 1 trillion, is going to be borrowed here internally. And therefore, I think I picked this conversation with quite a number of friends, whereby we were having this conversation. And of course, then that would mean that the government is going to be competing with businesses in borrowing from the financial, of course, largely from the financial institutions here within the country. And then, of course, we would be looking at the direction of banks having good and hefty returns, but also pointing to the fact that interest rates then are going to be considerably high. Having in mind that you're doing around 14.9 presently, therefore that rate really is not going to come down anytime soon because of the crowding effect that the concentrated 90% in borrowing by the government is going to be done within the country. So then one may be asking themselves, why that? Why not go outside and then concentrate with borrowing internally? The reason for that has been largely to really look into the exchange rate. Yeah, of course, we know that if you are borrowing externally, then you're paying your debt obligations and the interest in dollars. Therefore, that would have an effect on the exchange rate, whereby the demand for the dollar then would be high. And then, of course, that raises the debate, what works best, what works best for the country? Do we work with a relatively higher interest rate? And now have to consider, having to consider now that you're going to be work with a relatively stable exchange rate, which has been stable, I think, for quite some time. Yes, for quite some periods actually now. And all this is actually contained in that debt policy paper. I think it would be interesting for anyone who really has interest with the issues of debt can actually look at it. It's a very interesting paper. And then, of course, about 600 billion is going to come from the appropriation in aid. And with appropriation in aid, we mean the funding by way of the government services that you pay to in the government agencies that you go for, whatever services that you go to. Think of the school fees to the public institutions, university, tertiary education, and also government hospitals. Yeah, if you're seeking health services from a government hospital, there's that really, you would say, subsidized fee that you pay. So that is what goes to the AIA, the appropriation in aid. And that is then being projected at 0.6 trillion. That is roughly 644 billion. And the last component is on the grant, which is roughly 44 billion Kenya shilling. Yeah. So largely that's it as regards the issues of the budget. And maybe in closing, as we talk about the budget, of course we understand that the ministry, the docket that really has received the biggest chunk of this budget is the education sector, and rightfully so, really. To make to educate the country. I think education, we can all agree, is of great importance, and appropriate emphasis then ought to be given by way of allocation. And I think the other thing that maybe we would mention about is the issue of PPPs. Yeah, the public-private programs, whereby the government invites investors to invest in some certain infrastructure projects, and then the investor can then recoup their funding by way of levying fees for the use of that particular infrastructure, by the use of whatever service, be it maybe construction of dams. And for this kind of coming financial year, the government is projecting to do about 30 PPPs, yeah, going into some of them into construction of dams. Even though I saw a very interesting report today, whereby that still is it's a very hot area. But also maybe to mention that the uptake of the PPPs has not been very impressive. Yeah, whereby whatever the government has projected to issue as PPPs in the last financial year was not the case. Yeah, there wasn't the full uptake of the PPPs. Yeah. Yes, so it's one of the ways that the government is financing its project. And of course, this now comes with the fact that the management of the infrastructures that are being developed through this way are going to be retained within the control of the private players, who are then committing their funds by way of this kind of funding. So then moving forward, we can talk about a few things about the finance bill, some of the proposals being introduced by the finance bill, and also maybe talk about why the proposals and how to best comply to those proposals. So one of the proposal is the change in the filing dates, whereby we are then going to expect different kind of taxpayers having different filing dates. Talk of individuals with new returns, talk of employees, and talk of businesses. And maybe to mention that for all individuals in the country, as an individual taxpayer, you cannot have a different accounting period. You cannot have a different financial year other than from January to December, and that is anchored in law. But for businesses, you can choose. It can be from any month to any month of your liking. And so what then you're seeing that for individual taxpayers who are filing new returns, they are going to be expected to file their returns by 30th January. It's not fast, but rather it's 30th January. of every year. And with nil filers, it is whereby if you didn't have any income in the just concluded financial year, then you're going to be required to do your returns by 30th, by 30th of January. And for the employed persons, and when you talk of employed persons, we are talking of if you've not been doing maybe other kind of businesses, think of you still are employed, but you still have other sources of income, then your date of filing is going to be 30th of April. Of importance to note, while mentioning this, these are clarifications that are further being given by the CS. When he was reading the budget, when he was making the budget presentation to the Parliament, the green copy of the finance bill as worded is not capturing some of these specific details that I'm mentioning, and we hope that in the final copy, a lot of this clarity is going to come, because as per the existing finance bill, what we have is that for every business is then going to be expected to be filing their returns by April, by 30th of April, after the end of the financial year. And because majority of the businesses in the country have their financial year running from January to December, then it would mean by 30th of April, then the said companies would then be required to have filed their returns. But clarity has since been provided by the CS, whereby he's talking of businesses now having the same deadline as of 30th of June. But of course, if you're doing installment taxes, you're supposed to have cleared your installments by 30th of April of every year. So it's important that we get this distinction so that we can also share this message with our friends, with our colleagues, and also with any person who would be interested. So I also said, why then the change in the filing periods? The reason given is because, and really what the CS was trying to allude to, is because you find there are so many people filing their taxes in June, even nil filers, really, who didn't have anything to declare. They are waiting for the month of June. And that causes problems with KRA, whereby every other person now is rushing to file their returns, and then KRA, you're having issues with ITAX, and therefore that actually is the reason that the CS gave. That is good. We prolate the filing of these returns so that we do not have the system having issues and all that. So now moving forward, a few of the things that are being recommended is the introduction of quite a number of withholding taxes, especially within the digital payment platforms, and the implication on the daily cost of living and all that. And the first introduction is the introduction on the sale of scrap metal, whereby, so how withholding tax works is that if you buy something and whatever it is that you're buying, you're required to withhold tax, then you're required not to pay your supplier the full amount, the full invoice value. You then are expected to subject that payment, that service, that product to withholding tax and subject it to 1.5. And therefore, what then the bill is seeking to introduce is a 1.5% on the gross sale of scrap metal. Therefore, if you're in the business of buying scrap metal, then you're going to be expected to be doing a 1.5% withholding on the sale of the scrap metal. And this has been a very interesting space to watch, because it gets introduced in the bill, but it never gets to the final act. Yeah, I think this is the third time where we are seeing this kind of movement, and that is together with some errors some unfortunate errors which have been committed in the previous bills that we've been seeing, whereby the wording or some certain sections have been very contentious. Where clarity really has not been provided previously, and therefore this now is coming back, and therefore, like we are saying, if you are going to be buying scrap metal, then you're going to be expected to withhold a 1.5 on the gross value of the sale, which is interesting because withholding tax largely applies on the net value, of the invoice. The other is the introduction of the withholding tax on cards, whereby largely affecting the banks, whereby now the banks will be required to be subjecting a 1.5% on the transaction chain on payments settlement. And there's been quite a lot of conversation on how this is possible, given the amount of transactions that the banks then process, typically process in a minute, in seconds, and that kind of a thing. But we hope that the CS then is perhaps going to simplify or drop this particular provision altogether, especially because it's going to be hectic on the administrative side of it, the implementation side of it. Again, because we know how the volume of transactions that the banks deal with. The other introduction that is going to be done is the expanded definition of royalty to begin within the purview of withholding tax, payments for the distribution of softwares by people selling softwares. This is so contentious in the sense that, and again, to mention, this has been coming on and being dropped. And this is being informed, maybe just to mention, it's being informed by quite a number of cases that, some of these changes are being informed by the court cases that KRA has been losing, whereby they feel because we've lost this case, then we are going to legislate that particular outcome that we preferred or the outcome that we wanted. Yeah, so they want to expand the definition of the word royalty. And by industry practice, by the standards that we know, royalty, when you're paying a royalty, you're paying for the exploitation of a particular intellectual property. Yeah. Therefore, the supply of a software does not mean that you're actually using that software. Yeah, really, to simplify the language, you'd be paying for a royalty if you essentially are using that particular patented or maybe licensed product. And so what then the CS then is recommending is to expand that definition to include where you're buying a software to be used by somebody else. Yeah. And of course, that is very contentious because really it's not the global practice. And we hope that is going to be looked into. And also maybe the commissioner really would stick to introducing legislative measures which comply to the industry practice and also the global and international practices. There's also a very interesting provision that is being introduced, and that is the introduction of a tax regime that is targeting non-resident persons. And to really explain who a non-resident person, I've been getting quite a lot of questions on whether a person living abroad would qualify to be a non-resident. And the answer is yes. And it is yes because a Kenyan, essentially a Kenyan citizen, really, to simplify it, you would qualify to be a non-resident if you've not been to the country for any financial, for any day in that particular financial year. But if you come into the country, even for one day, then you would qualify to be a resident, and the tax implication that come with being a resident would then have to be followed. But if you're Kenyan and you've not been to this country even for a day, then you do qualify to be a non-resident. But largely, the emphasis has been and the focus has been, we have foreigners who own properties here in the country, and then we have the occupiers of these properties paying rent directly to them. Yeah. And so what then this bill is proposing to do, that if you're non-resident, you have properties here in the country and you're earning a rental income, and that rental income is not being collected by an agent. You've appointed an agent to be collecting that rental income within the country, and that agent is here within the country, then you're going to be required to make an application for this particular rental regime that is being introduced, particularly for non-resident person receiving rent income directly and not having an intermediary then or an agent. And the rate of tax is being proposed to be at 30%, and then that tax is going to be paid by 20th of every month. Yeah, so that is a very interesting introduction, and we are going to see how that is going to be to be applied. So moving forward, there is also sort of a limitation that is being introduced for the utilization of a recent introduction that we saw in the Income Tax Act, whereby gratuity payment had been exempted from tax if they are being directed to a pension scheme. Yeah. So now we are seeing a limitation being introduced. I don't know what could have informed this particular introduction, whereby if you're directing your gratuity payments into a pension scheme or an equivalent registered scheme, up to a tune of 360,000, that was being exempted. But now, for you to be granted this exemption of 360K per year, then the CS is proposing to say that your contract should be over at least 3 years. Yeah, 3 years, and your contribution to that to this scheme should not be more than that 1%. Should not be more than that 1% of your pay, and also it is also going to be added to your contribution. Will also be tied to the amount of pension that you're contributing to this pension scheme. So collectively, the amount that go by way of gratuity and the amount that also go by way of a pension should be a total of 360,000. Yeah. So for majority of people who work who are engaged in short-term projects, in short-term contracts, by maybe people who have projects that are running for less than 3 years, then they would be disadvantaged from taking this particular provision. The other provision that the bill is seeking to do, or rather to introduce in personal taxes capacity, is the expansion for the utilization of the allowability for deduction for mortgage interest if you have no mortgage and you are employed by the Central Bank of Kenya. So how this works is, if you have a mortgage and you take your mortgage from we call them the first 6 listed financial institutions in the fourth schedule, which, by the way, have recently been increased to include the SACCOs. Initially, they used to be the first 5, but that has since been increased to 6 to include the SACCOs. So this tax allowability, this tax deduction allowability is now being extended to the employees of the Central Bank of Kenya, whereby if you have a mortgage and then the CBK the CBK extends a mortgage to you, you would be in a position to utilize that particular tax allowability deduction for the mortgage component up to the tune of 360,000 per year or 30,000 per month. And of course, this is because the CBK doesn't qualify to be regarded as a financial institution because it's governed by its own act. But for the banks, for the SACCOs, for other kind of financial institutions, they have a shared piece of legislation. Could be the Banking Act, can be the SACCO, they have their own act. Can also be the mortgage refinancing institutions, they have their own. But also the CBK has its own. And that is why this very special provision has been introduced so that those working with the CBK then are not, and also get to enjoy that particular benefit that is granted to majority of people, because majority of Kenyans take their mortgages from those six financial institutions. So moving forward is the extension of a certain benefit. Excuse me. The extension of a benefit, of a pension benefit arising from death, whereby if you've been working, if you're employed and you've been making a certain contribution to a pension scheme, and then unfortunately you pass on, if then you pass on, your beneficiaries will be in a position to enjoy that pension without it being subjected to taxation. Of course, this is an expansion to the existing provisions. In addition, maybe to the existing provisions that that allow some certain withdrawals from pension schemes not to be taxed. Either you've reached the age of retirement, you need your pension out of illness, amongst others. And therefore, what then the bill is seeking to do is, if you have a pension that you've been contributing to and you do not meet those earlier provided provisions, like I was saying, either you've reached the age of retirement according to, you've reached the age of retirement, or you've been to that particular scheme for 15 years, you've been, or rather you need this benefit because of an illness, then you are seeing this extension being done by way of you would be in a position to get access to this benefit, this pension benefit that you're entitled to, if the person making the contribution passes on. And of course, this is to encourage the transfer of full benefit to the dependents. Yeah. The next two introductions are administrative in nature, whereby the commissioner then is saying that if you had a PIN and then you stopped operation, you applied for the registration of a particular PIN. If then you approach KRA for an application of a PIN, maybe as a company, you then want to resume with the operations. If you make an application, you're going to be granted the earlier PIN that you had. You're not going to be granted a different PIN. And of course, this is to help with the administrative aspect of it, whereby we've been seeing taxpayers having multiple PINs. Yeah, we've been seeing a scenario whereby taxpayers have so many PINs, others maybe with existing tax obligations, and therefore that is no longer going to be the case. And additionally, also maybe to mention that there's going to be a very interesting provision whereby, and of course I hope that I'm going to see this in the final bill, whereby some certain taxpayers, maybe students and those kind of people who need a PIN so that they can access some services, but not because they are earning an income, would be in a position to be granted a PIN without necessarily having an income. Remember, the wording of the Income Tax Act is that if you are earning an income, then you ought to register yourself to have a PIN. But we've seen maybe for the case of students, we've seen if then you're reporting to a university, at the point of making an application for help, you're required to have a PIN. But you essentially are not making an income by the fact of being in the university, maybe, even though you could be having some small income, really, uh, you're required to have an income so that you can access some services, including health and some other services, really. So I hope that I'm going to say that because really it's a welcome move because majority of us, I think we remember, we at one point, we actually had to approach KRA and request them to waiver some certain taxes, which we didn't know that we actually, we didn't know that they were existing at that point in time. And therefore, it's a welcome move. The other thing that is going to be introduced in sort of an administrative nature, it is whereby KRA will have the power to originate assessment. Yeah, a few weeks ago or a few days ago, we've received communication whereby KRA has said that if you do not file your taxes by 30th of June, then you're going to be assessed, you're going to be given a default assessment, whereby KRA is saying, given the information that we have, you're going to be given a default assessment. And for default assessments, they are issued depending on some certain circumstances being met. Like for instance, if the commissioner believes you're going to leave the country without having filed the returns, they can issue a default assessment, among other provisions. But what is being introduced in this case is, in simple language, a pre-fulfillment of an assessment. A pre-fulfillment of your tax returns, whereby KRA, even before you get to a point where you're filing your returns, KRA then is going to populate your returns, which is what really has been happening. It's only that now this is being coded in law, whereby we are going to be looking at the withholding tax credits that we have. We are going to look at the audit data that we have. We are going to look at the eating receipts that you've actually generated. And because we have the visibility with the help of the technology, we have the visibility of all this information, then we are going to be issuing a return that is already pre-filled. And the conversation really that this is taking is, remember, in Kenya, we operate something called self-assessment, and we are looking into the direction of dual assessment, whereby KRA will now have the power to issue an assessment at the point of filing your original returns. Yeah. And then you will also have that provision and that ability to still do your annual returns by way of self-assessment. Yeah. And of course, now where you disagree, you can approach KRA. But this is going to be very interesting because, in fact, today I was dealing with a taxpayer whose their annual returns are actually reflecting whatever she's required to file is much more than the total sales she did for the last year. Reason being, the person who did uh, the withholding credit, the withholding tax on the Income Tax Act, not the VAT Act, based it on the gross value. And if you know how this works, is if you're VAT registered, your net sales, or rather your sales for the year, are the net sales of VAT. Yeah, the VAT component is not included as your total sales for the year. But now, because there's somebody who based an income on the Income Tax Act, then
Wakaba? I think we lost him. Let me try and get him.
Okay. You can confirm. All right. Oh, okay, fine. Thank you. I understand the issues on my end. I actually thought it was from your end, but that's okay. Yeah. So we hope some of these things then are going to be ironed out before the full, before the full implementation of this particular provision that is being recommended by the CS takes effect. Yeah. So moving forward, we are going to be looking at the pay to play, whereby the CS then is proposing to repeal the section in the Tax Procedures Act that limits KRA from pursuing tax collection if you have already appealed that particular case, either tax appeal tribunal or the higher courts. That being the High Court, the Court of Appeal, and the Supreme Court, and all that. So what then the commissioner is proposing that immediately an assessment is confirmed. Yeah? Remember, the process of assessment involves, sort of a preliminary assessment being granted, and then you engage KRA, an assessment can be confirmed, and after confirmation, you can raise an objection, and then KRA gives the objection decision. And after the confirmation of the objection decision, that is the point that the taxpayer now pursues the judiciary, the legal provision of seeking justice, and they start at the tax appeal tribunal. And therefore, what this proposal then is seeking to do is to empower KRA to be pursuing a taxpayer even where a taxpayer has not exhausted the the legal mechanism of seeking justice. And I think this is not fair. It really is not the correct way to go about it, even though I understand that some of our East African partners are already implementing it. It would be a disadvantage if we are to borrow some certain provisions which are being done elsewhere, and then we copy paste them for the simple fact that they are being done elsewhere. Yeah, of course, having in mind that we operate in different constitution framework, and especially so because our constitution provides that access to justice shall not be impeded, and where a fee or an amount is going to be paid, then the state is then required to show that that amount is actually reasonable. I think it's Article 48 or 45 of the Constitution does provide that. And therefore, we are going to see how this plays out, but it's a big impediment to taxpayers seeking justice. Even though the CS has also been mentioning that that some certain taxpayers pursue those legal mechanisms so as to delay paying taxes. And I think he also mentioned that we have a tune of several billions that are stuck in the judicial system. Really, it's then for the state to make sure that these cases are concluded quickly. Yeah, really, it is not to incentivize KRA to be issuing inflated assessments so that they can collect more. And of course, the other conversation would be how then, after the winning, where you have a taxpayer who has won the case, how soon would then be given the refund back? And in addition to that, are they going to be given the original assessment amount, or the commissioner is going to appreciate that there's passage of time, and you know, and that might now raise the conversation for the need of the inflation adjustment. Yeah, it's quite unfair, and I hope some of those things then are going to be looked into. And the next thing that the bill then is seeking to introduce is a reporting framework for virtual asset providers, whereby for the taxpayers operating a virtual asset service, you know, essentially the crypto services and the like, they are then going to be required to be providing this information of the traders to the Revenue Authority. This is in further compliance with the global practice. We are seeing a shift towards that direction, whereby countries are sharing this information so that they can exchange. We have an existing legal framework within the Tax Procedures Act that allows for the sharing of information of some certain bank accounts within some certain financial institutions. And therefore, what you're seeing is an extension of this being done in the virtual asset trading platforms, whereby now KRA will have now that ability to be sharing this information with other states that have the same provision of the sharing of information. The other thing that is being introduced is really an emphasis on the need of the taxpayers to comply to ETIMS, the ETIMS compliance framework, whereby KRA then is saying that if you don't comply, then you're going to be fined twice the value of the tax due. And then for an individual, you're going to be taxed 100,000, or rather fined 100,000. And then for an individual, it is 10,000. And then for an individual person, the fine is 100,000. Yeah, there's quite a lot of additional framework really that has been introduced to help implement this, including a very interesting provision actually that I saw that seems to be an indirect admission that ETIMS might not, the design of ETIMS as is might not be in a position to capture every aspect of the business, whereby they are saying where there are some challenges, where a taxpayer has some challenges with implementing ETIMS or issuing ETIMS compliant invoices, then KRA is going to exercise some leniency on them, and that is now being hard-coded in law. Initially, there wasn't that provision, which I think is also a good way. It's a good introduction, and also really to acknowledge the dynamics of a typical business operations. Yeah, moving forward is the issue of funds. I want to give clarity on this issue because it has elicited a lot of conversation. And really the question would be, I know the question that most of us have is the price of funds going high or down? And the answer is that the cost of funds is going to go down, because there is quite a lot of levies and taxes that are being removed, quite a lot of taxes and levies being removed, including VAT, import duty, railway development fee, import declaration fee. So all those levies are being removed, and now they are being replaced with a single exercise duty on fees exercise duty on funds at the rate of 25%. Yeah. So the cumulative those taxes, including VAT, excise duty, which I think was about was it 12? Yeah, 12% was cumulatively higher than 50%, between actually 55 to 65 actually, cumulatively of the original cost of the phone, and therefore this is now being replaced with a single with a single with a single exercise fee of 25%. And of course, that would mean that the cost of funds then is going to go down. The other interesting thing that I didn't expect is the reclassification of some certain things, especially the products in the e-mobility space, given that the president has been very vocal on promoting environment-friendly products. And I think we recently saw a very big expo, a very big forum that invited players in the e-mobility space. And what then is happening is that these products are being reclassified from zero rated to exempt. And of course, that would mean that their costs are going to go up, because for a taxpayer dealing with these items and they are exempt, it would mean that of course they wouldn't be in a position to claim the VAT component of their inputs. And typically, like any other business, what we expect then is that these businesses are going to transfer this cost to the buyer, and of course, then that would mean that their costs are going to go up. And by extension, is the same thing for the animal feed. And maybe just to mention the motorcycles, the electric bicycles, and cars, we then are going to see an increase in their cost. Next up is the issue of Mituba. We've seen Mituba being exempted from VAT. That is, for a trader selling Mituba here in the country, they've been exempted from VAT. But also in the actual green copy of the bill, we didn't see whatever was in the headlines, that there is a tax being introduced in the Mituba, in the second-hand clothes. But reading between the lines, this could be something that will be introduced in the final bill, whereby if you're in the business of importing second-hand clothes, then you're going to be paying, in addition to the customs, you're going to be paying a certain percentage that is going to be anchored in the Income Tax Act at that point of importation, which is going to be the final tax, for the importer. Therefore, that is not, I think for emphasis, I need to mention that it is not in the bill, but we are going to be on the lookout whether it's going to be introduced in the final bill. And of course, updates will follow as would be the correct thing to do. The next thing is the introduction of excise duty on classic cars, whereby we are saying that for a car that the initial date of registration is more than 30 years old, is more than 30 years old. Additionally, this car costs more than 10 million. There's an introduction of excise duty of 50%. It's quite a figure of 50% of the value of this vehicle at the point of importation. Therefore, if you're planning to import that classic car that is more than 30 years old and goes for more than 10 million, then in the coming days, in the coming months, then you ought to plan for that well. And I felt maybe then it would be important for the CS to have a transition clause on this. It would be important to have a transition clause on this for the sake of maybe those people who didn't budget for this particular provision that is going to have an implication in an increase in the cost. So moving forward, and also maybe to mention that we are also close to coming to an end of this, it is the removal of excise duty on bottled water, whereby, of course, this makes sense given that excise duty, historically, maybe for context, excise duty is levied, was primarily intended to be levied on one thing. That is, in fact, it was called a sin tax. Yeah, it was called a sin tax, and it was being levied on products that are harmful, either maybe to you as an individual and also maybe to the environment. Yeah. So then what we've seen recently is that the excise duty has been expanded to bring within the ambit of Excise Duty Act financial services, and now we are also seeing that expansion fall in other categories, and other categories like the luxury products. And the initial reason for the introduction of excise duty on the bottled water was it was being regarded as a luxury item. And I can think we can all agree that really bottled water is not a luxury item. And it's therefore a reply to the taxpayers and the many people doing this business. I think we've been seeing this businesses being very common in the estates. And of course, really, we then are going to hope that these traders then are going to remove the excise duty component in the price that they were transferring to the buyers. Another very debatable introduction that is being done, that is being introduced, is the discretionary powers that have been granted in the Income Tax Act, whereby the commissioner will have the powers to subject 60% of retained earnings, yeah, to the commissioner will have the powers to regard that as dividends, yeah. And I felt this needs quite an exhaustive regulations, quite an exhaustive criteria for compliance purposes by the taxpayer, because what we've seen historically, and especially at the tax appeal tribunal level, the tax appeal tribunal has been very conservative in overturning the discretion powers of the commissioner. And what I mean is that if the Income Tax Act or another act has empowered the commissioner to exercise his or her own discretionary powers in arriving in a conclusion, then the courts have been very slow or they've been very conservative in overturning that decision. And therefore, why I feel this is very contentious is because if then you have a business that wants to comply but doesn't have a criteria of the number of things that the commissioner would be looking at to determine whether these dividends are going to be deemed as distributed and withholding tax applied therefrom, it would be very unfair because, businesses retain earnings for many reasons. And among the reasons would be to fund their working capital. That is number one. It can be a company can retain its dividends so that it can invest these retained earnings in future. Yeah, a company can also retain its earning for the share buyback. Yeah, if a company wants to buy back its shares, then it can retain. So all these scenarios that we are talking of, all these varying provisions, all these varying reasons why the businesses can retain their earnings are left at the discretion of the power. So in as much as maybe you would be having a very compelling case, commissioner is not tied by any provision whatsoever in law to consider your case. And therefore, you are at the mercy of the commissioner to deem your retained earning as distributed dividends, and application of withholding tax then would be done. And also maybe to mention that the 60% is not final. It is at least 60%. And therefore, the commissioner would then be in a position to go all the way to 100% of your retained earnings being deemed as dividends and withholding tax then being applied. The other introduction is a provision that is speaking into the inconsistency of the tax laws, whereby tax on bad debt will now be claimed after 3 years, which is now being reviewed from the existing 2 years. Also very interesting because we've been having a lot of policy shifting, particularly in this space, whereby we've been seeing 3 years being reduced to 2 years, and now we are seeing 2 years now again being moved to 3 years. So it's important for you to consider that. And also the other introduction that is also speaking to the inconsistency of the tax policy is that you as a taxpayer will not be in a position to claim VAT on imports to offset other type of taxes, that that might be, you could be having an application for a refund for, and therefore, if you've paid VAT at the point of importation, then you wouldn't be in a position to utilize that payment for other reasons. And I think this was only introduced recently. It's actually roughly a year old, which the reason for the introduction was actually because it had been omitted, but now we are seeing it now being removed. And I don't know why that is happening. And I hope maybe then the CS would be in a position to give much more clarity on that. So if we can move on to the next slide, maybe just a recap of a few things is for us really to take note that the tax amnesty is being introduced again, and therefore, if your iTax, if your ledger account is in a mess, you're going to have now the time to look into it, to correct the errors, to correct the mess that you're in for the next 6 months. So the tax amnesty will run from 1 January of 2026 all the way to 31st December of 2026. And it is going to cover all interest and fines accrued before 31st of December 2025. The most important thing then that you want to pay attention to is the only requirement for you to be able to utilize the tax amnesty is that you'd have to pay the principal tax. Yeah, the principal tax is not covered by the amnesty. That one you still have to pay, and that really is the correct way, because really the Constitution provides that tax can only be waived by a legislation. Therefore, what the tax amnesty is going to be covering is only the interest component and the fine component. And for you to be able to utilize the waiver of the two, you will have met the criteria of paying the original taxes. That is the principal tax you ought to have been paid. Yeah, 100%. So maybe just a recap is we've talked about the pre-population of returns, whereby KRA will have the powers to originate returns. Therefore, really exercise a lot of attention into the way that you deal with the e-systems, the electronic systems. Please be careful generating that ETIMS receipt. Exercise a lot of caution. Be careful before you hit send, because the commissioner then is going to have all this visibility, and they will have now the powers to originate these assessments. Failure to comply, of course, with invoicing, we've mentioned about the fines, whereby we're talking of the commissioner now having the power to tax, or rather to fine you twice the amount of tax that you ought to have been paid. That is the higher of twice the amount. If it is an individual, a fine of 10,000, and for an individual persons, then you're going to be taxed at 100,000, a minimum of 100,000, and a higher of 100,000, and twice the amount that is due. So moving forward would be to really mention in passing whatever is not there in the bill. I've been talking and really having conversation with quite a lot of friends about how the issue of the finance bill has become a very political subject, whereby, for instance, I've been hearing quite a lot of provisions that are not the bill, but because I know some of us who are here need this information for their compliance reasons, it is important that we get whatever is correct. And one of those provisions that is not there, it is the 7.5% on residential rental income remains as is. So this is not being increased to 10% as is being mentioned or as is being said out there. It is being retained at 7.5%. Also, the issue of the PYE, it is not being reduced for now. Therefore, for persons earning 30,000, that stays as is. And also the PYE bands have also not been reviewed. Therefore, for any person earning 24,000 and above, then they would be paying taxes. Yeah, so that is not being affected. But I think the CS in Parliament, when he was reading the budget, he did mention that these are some of the things that we could be looking into in the future. I don't know whether it is still projections that they are still working on, but it would be a very welcome move and a very welcome legislative measure being introduced by the CS. And if it's not going to be in this finance bill, then we are also going to be expecting it to come in the coming days by way of a tax laws amendment bill, sorry, or a similar bill. Yeah, and also maybe to mention in closing, one second. Also, maybe to mention is, or maybe to preempt the question that now we have the finance bill. Are we then going to expect additional and future changes between the point of introduction of the bill and the assentment of the bill by the president, therefore becoming a finance act? Are we going to expect changes in this period and in this time? And to answer you, the answer is yes. And this is an issue that that the Supreme Court actually decided on when it was making the determination on the unconstitutionality of the Finance Act of 2023, whereby the Supreme Court actually pronounced itself and said that yes, additional introductions can be done, and therefore it's true we are going to expect quite a number of changes from the bill that we have, in as much as we still are not going to have that ability to give our public comments, and therefore it's only the members of the parliament who will have that advantage of giving their inputs, and we therefore hope and pray that they really are going to present our views, because by law and by the provision of the Constitution, that is their mandate. And we hope that they are going to exercise that, having our interest at heart and in their minds. And with that, is to say thank you, which is in the last slide, is to say thank you for your attentiveness, for your time, for your attention. You've really paid attention to this, and I'm grateful for that. Thank you for giving me your time. And I hope that I've shared insights that would be of importance to you, either by way of application, either by way of quenching your curiosity, or maybe informing your friends. It's important that we share this information with our friends, with our colleagues, and also really to thank you, Mikaeli, for this webinar, because it disheartens me so much when I hear wrong information being shared out there, which causes a lot of apprehension, which causes a lot of panic. And therefore, to have this platform to share this knowledge with each and one of you, and for you to really pay attention to it, I must say that I must express my gratitude to you and to say Thanks to you all for your time. So with that, back to you, Mikaeli.
Thank you, CPA Dennis. That's been a great session. We can maybe appreciate him with the online cheers, hand claps. I think I'll take this time to just take questions from the floor before I ask what I have. So if there's anyone with a question, you could probably raise your hand, or Ndeto, you're unmuted.
Awesome. Thank you for the full presentation. I think this has been a very, very interesting conversation. So suffice to say, I'm very glad to have joined today. As you said, my name is Ndeto, and I work in quantitative finance with focus in financial markets, risk management, and capital markets, and of course, the policy issues that shape investment and capital formation. My question, I guess, revolves around, are there any plans to revise the taxation of capital gains, looking at dividends, bonds, properties, or collective investment schemes to encourage deeper capital market participation in Kenya? And in particular, how does the government balance revenue mobilization objectives with the need to attract both domestic and foreign investors in long-term investment vehicles? So basically, that's my question.
Wow, fantastic. I feel elated already for such an interesting question. And as regards the government working around the issue of capital gain tax, we've seen two introductions actually being introduced in this bill to encourage the uptake of investment vehicles, but the bias for this time round was in rates, that is in the real estate investment trust, whereby an exemption has been granted to persons transferring their properties to a real estate investment trust, which really is an investment vehicle, which some of us might be conversant with. And therefore, so what happens for anyone who wants to transfer a property, say for some certain given exemptions like currently existing in law, if you're transferring a property between one person and the other, usually there is the implication of capital gain tax. And that is what Ndeto was alluding to. And therefore, what then the government has proposed is so as now to encourage, the uptake of rents and really to promote the advancement of rates, which has been have been very upcoming for quite some time. But also maybe to mention that the uptake has not been very encouraging. It's very interesting that the government has looked into this and thought that so that we can catch the peers. I'm feeling the urge to to really talk so much about this, but I'm going to restrain myself issues of tax, but also maybe to mention that rates were also being introduced at the same time when South Africa was promoting rates, the real estate investment trust. We introduced these investment vehicles at the same time with South Africa, but the uptake in South Africa has been enormous, has been nothing short of enormous. But here in Kenya, we only have a handful. We only have a handful. And therefore, the government has looked into this and thought that, hey, we need to improve these collective investment schemes so that we can promote the uptake. So that is number one. Number two is as regards the offloading of shares by, offloading of shares in offshores arrangements, that has also been exempted in tax by way of a holding company. So if you have these shares being traded, but this is happening in an offshore kind of an arrangement, kind of a setup, it is also that is also now being exempted. As regards the government balancing the need for revenue mobilization and encouraging foreign investors and even local investors to uptake investment opportunities here in the country, the way the government sought to really mobilize this and to really encourage the investors to come on board is by the earlier policy paper that I was talking of, the MTRS, yeah, that is the medium-term revenue strategy paper, which was being introduced in the year 2023 with the aim and the objective. The primary objective of that was to give confidence to the investors, whereby the government was preempting the future tax changes that is going to do. But now we've seen quite a lot of a very interesting trend whereby the government has not really followed through those policy document papers. And it's been quite unfortunate that the implementation of that policy paper, my rating has been less than 50%, to be honest. And I'll say this, the uptake and the implementation of that policy paper has been, my score is out of 10 is maybe 4.5, I would say. Yeah. So this is one of the ways that the government has been encouraging the investors to uptake the different investment schemes, investment vehicles, and investment opportunities in the country by querying the question, are we operating in an environment that you can make long-term decisions? And the medium-term revenue strategy paper borrows largely from the national tax policy, which has the timeline of up to the year 2030. So the national tax policy, which provides the broader framework, is being implemented by the MTRS, the medium-term revenue strategy paper, that is in part coming to an end in this coming fiscal year. And then thereafter, we are going to have a different MTRS. And we hope that the government is going to be follow through that whatever measures that they are going to recommend, so that they can communicate confidence and certainty to the investors, which I think is very important, and especially so because I've been privileged for sure to sit somewhere that I was in a conversation about do we pursue a particular investment decision, albeit in a different kind of a setup, but the government had given a certain policy framework and policy direction, which they abandoned not even a year after. And that caused a lot of disorientation, whereby the investment that we had decided to commit ourselves to in that aspect, we then had to actually put an end to that, and to count our losses in capex, which was very, I must mention, was very painful. And we hope that the government is going then to honor this policy framework and policy decisions that they communicate to the public, to the Kenyans, and also to the investors at large. Yeah.
Nice. That's a good response. Any other question from the floor? Okay, so I can proceed to ask my questions.
Okay. Maybe also to mention that I will share the slides. I can see somebody is asking for the slides. I'll share the slides to Mikaeli, then she'll be in a position to expand. I mean, to share that with each and every one of us. So over to you, Mikaeli, for your queries.
Okay. I had a number of them, but you've answered some while you were speaking, especially on the debt sustainability. In terms of pending bills, is there a correlation with what you're speaking to in terms of the behavior we're seeing from the private public programs, the PPPs? So is it that the private sector is not interested in the uptake? Are they scared of government's ability to come through? Because I know there was a mention of the pending bills and the fact that government would try to sort out the small holder suppliers. So is this something that's related, and what would be your take around the pending bills?
Indeed, the issue of the pending bills has been a very thorny and very sensitive issue because so many investors and so many taxpayers have been caught up in the issue of pending bills because the government has been taking the direction of wanting to authenticate and to verify those pending bills. And a huge chunk of them have actually been cleared. It's only that the whole exercise has not been completed yet. And in the recent budget presentation by the CS did mention that he did a budget allocation for that very particular issue. So for the pending bills which have been verified, there was quite a number of billions that that figure is escaping my mind, but there was a budget allocation for that initiative. So then we are going to see, you know, sort of a stimulation to the investors because it is very unfortunate when you have your money, that you borrowed to do business, being locked in an institution, having done with a business with an institution that does not default in payment, and therefore having sold that assurance to your lenders, then taking this long to have your payment being cleared is quite unfortunate. And it's only justifiable, like I was saying earlier, that this compensation then ought to be adjusted to inflation, and such kind of adjustments that would necessitate to put these investors in a sort of an identification to their loss in time, inflation rates, loss in value, loss in time, and all that. So confirm that you asked the issue of PPPs. Did you ask the issue of PPPs?
Yeah, is it people are scared? People in the private sector scared of partnering? Is it related to what you're seeing in pending bills? Like people would not be interested to do business with
The
government?
government. Okay, interesting. Part of the reason, in my view, why the uptake, especially for this financial year, has not been fully witnessed is because I felt most of those PPPs were a little bit ambitious. I felt the government was very ambitious, and in as much as maybe those PPPs have also not been very attractive because number one of the uncertainty in the policy making space, but also it has also been speaking into the issue of, are we only inviting PPPs for the sake of building infrastructure, for the sake of engaging them in these projects that eventually they would take years and years before they recoup their original returns? Remember how the PPPs work is that an investor puts in their own money, and then they could be given, depending on the structure and the nature of the PPPs, which they vary, by the way. It can take the nature of you come with your own money, you invest in a piece of land, you put up an infrastructure, and then the government gives you the land, but you put up the structure. Other PPPs come in the form that you take up the whole space, you build, own up the whole enterprise, own up the property, and then charge as you so wish. Yeah. And then recently, and I think this is what I was talking of today, there was a certain PPP of a dam construction that has been going on that has now since been shifted from a PPP kind of an arrangement to a government operationalized kind of an infrastructure development, in the sense that it has been shifted for the reason that the fee that the private investor wanted to charge for the use of the service of that particular infrastructure was high. And therefore, the government then came in and felt, because we are having a disagreement on what you're going to be charging the Kenyans, the users and the taxpayers for the use of that particular facility, because we feel that is high, and because you have justifiable reasons that it's going to take long before you recoup your initial investment, then you are going to take this up and you are going to budget for it, and it is going to be fully implemented within the budget and the borrowing and the expenditure of the government. So yes, the uptake has been largely impeded by the government has been a little bit of ambitious in its projects, which is a good thing, but also there's a need to factor in the viability of the projects and also the return timelines that the investors expect to recoup their initial investment. Yeah.
Okay. Yeah. Okay, I think that makes sense. Let me just do the last one because time is spent. You've talked about education. You've indicated it's receiving a big chunk of the money. We've seen a drop in ICT. What do you read into this? Previously, we've seen 12.7 B being allocated. Now we're moving to 8.6. Yes, I know our priorities in terms of education. There's been a lot of noise across the country in terms of how much is being allocated to education. And now we are seeing shifts to that direction. But what do you see from an ICT point of view, given think of the digitization discussion and whatnot, even think of our schools and where we aim to have them at? Then any thoughts around the split of agricultural insurance to be an independent category? Yes.
Okay, fantastic. Number one, on the issue of budget allocation of the education sector, there was a very interesting report that was published by the Kenya National Bureau of Statistics, KNBS, whereby it was an economic survey from the year 2021 to the year 2025, came out sometimes last month. And there was a very interesting and a very damning report, which was on school enrollment, whereby the number of students, the number of kids who've been reporting to school at the primary level has been on a decline. And that is very unfortunate because at minimum, one would then have expected the enrollment to sort of remain the same. Yeah, even if maybe it's not increasing, can it at least remain at the same level and not even decline? Because I bet we can all agree that the population of the country is going up. And if the population has been on an increase, we cannot have enrollment into primary school being on a downward trajectory. And therefore, if it is on a downward trajectory and the population then is going up, it can only mean that, whatever is happening is not correct, and the school enrollment is has been impeded largely, especially because of the fee structure, think of the capitation and all that. And therefore, the figures on the school enrollment really needs to be looked into. But also, it raises the question: if you are borrowing. In fact, I was engaging in this conversation that during Kibaki's presidency, we borrowed to the tune, for the 10 years, we actually borrowed 1 trillion. Yeah, 1 point something, I think 1.2 or 1.1. And it is at that point that education was actually free. If then you are borrowing 1 trillion in 1 year, it would be justifiable that we look into this very important docket, which is the education docket, which we can all agree it's very important for the future of our nation. And therefore, the budget incremental would now seek to seal some of these things that maybe the government could have studied and looked at the economic survey report, and they decided that we are going to put much more finances into this docket. And therefore, I think for me, it's a welcome move. It's a positive initiative, but also hoping that, in finance, we say that a budget, budgeting is not an approval for expenditure. Yeah. Therefore, we hope that the budget estimates and the budget allocation are going to be followed through, because the incremental can be there, but is the implementation going to be followed through? I think that is very important. That incremental particularly goes to that docket. As the issue of energy, and ICT, which surprisingly their budget was actually reduced. The reason for that is because of the adoption of the different funding models that are being directed to the infrastructure and ICT and energy sector. Remember, we just talked about the PPPs, whereby the financing of these projects are then going to be done off the budget framework. They are going to be done by way of PPPs, number one. Number two, remember recently the parliament passed the infrastructure fund. Yeah. Therefore, it will be partly projects within the ICT, within the energy sector are going to be an infrastructure sector are going to be funded by way of PPPs and also through the infrastructure fund. Remember, all these are outside of the budget framework, and therefore that could speak into the decline of the budget allocation in that sector. Therefore, the only expectation I had, and I hoped that maybe the president would have been vocal about it, is as regards the issue of the construction of the data center. I think we saw the reports that we do not have sufficient energy to operationalize a data center in the country, in the whole country, whereby if a single data center would, according to the agreement that the president had with one of the international players to construct a data center here, it was projected that it would consume a third of the existing power being generated in the country. And because we are moving into that direction of artificial intelligence, and the need for the countries to strategize and to position themselves as ready for the uptake of the AI and the infrastructure that comes with it, I was expecting that the CS and the president would be very vocal about it, about this issue, and really to speak into the need and to the priority given into it by way of by way of budget allocation. But I hope it is going to be looked into by way of PPPs and also by way of the infrastructure fund. As regards the issue of agriculture, I must say I would have to look into it for me to be in a position to handle it sufficiently. Yeah. So I think I would return the floor back to you.
Thank you. Thank you very much, CPA Dennis. Any other questions from the floor? I know we are really, really past time. Okay, I'm assuming there's none. Thank you very much, everyone, for joining. I know Esther had expressed. Okay, maybe we could share our emails for those who would like to receive the presentation. I know the model of joining the session didn't involve an invite being sent to your email. However, you can reach out to us. I think I'll share both Wakaba's email and mine, just in case you need to reach out to us. Maybe Wakaba, you could type yours into the chat. They could probably be interested in talking matters tax with you. Yeah. I won't end, just to allow you to put that in. So thank you everyone for joining. I think we'll try to do this more often, just to ensure that we have an understanding of what's happening in this space. Thank you again, CPA Dennis, for agreeing to host us for this particular session. And thank you for the insights, as Esther has said. Until next time, thank you and have a lovely evening.
Okay. Have a lovely evening too, and bye.
Okay. Bye.